Every decade or so, markets collapse, millions panic, fortunes vanish, and yet we never truly learn. And why do market crashes keep happening? The answer isn't just money. It's psychology, biology, and human behavior. Today, we'll dive into the hidden forces inside your head that drive global financial meltdowns. First, your brain hates losing money. Losing $100 feels about twice as painful as gaining $100 feels good. This is called loss aversion. In a crash, it pushes people to sell at the worst possible time. But it goes deeper. When markets fall, your body releases cortisol, the stress hormone. It clouds judgment. Neuroscientists found traders literally make riskier decisions under stress, not safer ones. This explains why panic selling spreads like wildfire. Fear is contagious, literally. In uncertain times, humans copy others. It's a survival mechanism, but in markets, it becomes herd behavior. One investor selling convinces 10 more. 10 convince 1,000. That's how crashes cascade. Narratives amplify it. Headlines scream collapse, and our brains overweight vivid stories over dry data. That's why a tweet can move billions of dollars, because attention, not fundamentals, drives markets short-term. Crashes usually follow a script. It starts with euphoria. Everyone thinks they can't lose. Next comes a trigger, maybe bad earnings, a policy shock, or even a rumor. Then the air pocket. Prices free fall because no one wants to catch the knife. Forced selling accelerates it. Margin calls, leveraged funds, and automated strategies dump positions. That's when liquidity disappears. Spreads widen, markets gap lower, and volatility explodes. Finally, a bottom forms. Not because everyone feels safe, but because everyone who had to sell already did. 1929, 1987, 2000, 2008, and 2020, different eras, same psychology. In 1929, leverage from everyday investors magnified losses. Many lost everything. 1987's Black Monday showed how computers could panic faster than humans. In 2008, it wasn't just stocks. It was the entire global credit system breaking down. And in 2020, fear of a virus, not financial data, wiped trillions in weeks. Here's the brutal truth. Crashes don't destroy wealth. They transfer it from the impatient to the patient. Those who panic sell, lock in losses. Those who wait often recover stronger. Most people think they'll be rational in a crash, but neuroscience says almost no one is. Even professionals fail. In 2008, top funds liquidated at the bottom. The data shows the biggest risk isn't the market, it's you. So can crashes be predicted? Not precisely, but there are warning signs. When margin debt surges, volatility rises, and credit spreads widen, it's time to pay attention. Breadth collapsing, when only a few stocks rise while most fall, is another red flag. But most investors ignore these signs until it's too late. The key is preparation, not prediction. You can't time crashes, but you can survive them. Limit leverage. Crashes punish the overconfident most. Hold cash for liquidity. It's the fire extinguisher in a burning market. Diversify across assets. Crashes rarely hit everything equally. And then you need rules. When to hedge, when to rebalance, when to stay put. In panic, rules save you. And remember, recovery often starts when headlines still scream disaster. The investors who survive aren't smarter, but they're calmer. They understand that fear and greed will always exist. You can't erase them, but you can manage them. Your real edge is emotional discipline, not stock picks, not algorithms. Because in a crash, it's not the math that breaks, it's the human mind. History proves markets always recover, but not all investors do. If you panic, you turn temporary volatility into permanent loss. If you endure, you turn chaos into opportunity. The next crash will come, not if, but when. You can't control the market, but you can control your behavior. The winners of tomorrow's crash are already preparing today. The truth is, market crashes don't test your portfolio, they test your psychology. So when the storm hits, don't ask, what will the market do? Ask, what will I do?